Right now, the tech sector's fairly overvalued. It's due for a correction. This could be a healthy time to take some of those profits off the table. But
A major stock rotation is underway in the market right now. Our analysts share what's behind the big move and the opportunities it brings for investors, including which stocks are poised to see a big boost from the rotation. Let's dive in. Last week was really the start of this kind of phenomenon going on known as the Great Rotation, and things are moving quickly. Chris, Thomas, walk us through what is happening in the market right now.
Well, yeah, this started 2 weeks ago, last week with the CPI report, the June CPI report. It was much better than expected. And what that means is it shows cooling inflation that aligns with the outlook for FOMC interest rate cuts. And that signals a great economic shift, a pivot that the market's been waiting for. Up until now, the market's been led by big tech. It was very top heavy and concentrated. So this is kind of an all clear that economic conditions are going to start improving. And so the market has started to shift from just these big tech leaders into a broader array of stocks.
Chris, tell us a little bit more about that. How has this summer, kind of spring, really been for these big tech companies?
well, for tech companies in general, it's kind of been okay. I mean, if you're a chip stock, that's great. Cybersecurity had a pretty good run, but pretty much this spring and summer, it's been the same story it was in 2023, and that's you're focusing on the Mag 7, or maybe in this case, we'd say the Magnificent Six, because
Mhm.
Tesla has had kind of a difficult year. It was in the Mag 7 last year. Up until recently, it's had a really terrible year. Even this morning, about an hour ago, I noticed it was positive for the year, but just positive. So we can kind of take Tesla out of that discussion for now. But right now, every all of the other components of the Mag 7 are having a really good year. Nvidia down a little bit, but still up over 140% for the year. And all the other stocks have been really good performers. Apple kind of started the year sluggishly, but they're up well, and now even they're getting some analyst upgrades that suggest that stock might even be going up as high as 240 or 250.
So, knowing all of this, what does this kind of great rotation mean for investors then who have spent their summer getting into those Mag 7 stocks?
Well, once again, we'll put Tesla off to the side of that. That's a whole separate discussion that we've had on many occasions. What I would say is, um, and every investor has to do their own due diligence on this, but right now, this could be very well a time that you might want to consider taking some profits off the table. The market's due for a little bit of a correction in the tech sector, whether that's part of a general and a broader rotation. We'll see as the weeks go by. But right now, the tech sector's fairly overvalued. It's due for a correction. This could be a healthy time to take some of those profits off the table. But, and this is especially true if you're looking to trade this market, we are right up against tech earnings, and those are coming out within the next week or two. You might want to set up your options trades to hedge yourself so that if they surprise to the upside, you're not hurt that way, and if they surprise to the downside, you're also not hurt.
Right. I agree. There's going to be some near-term pain. We're definitely in a correction. There's
Yep.
definitely reasons for the market to sell off that have nothing to do with the CPI report. Valuations in tech, concentration. Many of these stocks are up high double digits, triple digits for the year. Good time to take profits. But ultimately, what we're talking about here is earnings power. Earnings growth drives the market valuation. We're still in a very good cycle for earnings growth.
Yep.
Earnings are supposed to accelerate for the S&P 500 through the end of the year and from this year to next year. So that's going to keep leading the market higher. Right now, we'll have a correction, but valuations will come down. Entry points will align with some better valuations, and I think we'll see a nice buy signal in tech and in the broad market by end of the summer or early fall.
So, knowing all of this, kind of how people are reacting to the CPI report and such, which sectors are investors rotating to right now?
Well, right now, I would say it's just about across the board. Um, but really, it's small caps. You know, the Dow made gains, the S&P 500 made some gains, the Nasdaq contracted, but the Russell 2K is up 10%, more than 10% in the week. Most stocks are up 3 to 5%. Many are up 15% or more. Now, this is where the small caps are. Small caps are higher risk names. They're more sensitive to economic conditions. So we're definitely seeing a shift into risk on assets.
Right. I mean, the market now believes in an almost certain rate cut coming in September. I don't know how accurate that is, but that's what the market believes. And that's where Thomas is saying the markets are going to move from the large caps down to the mid caps and the small caps because those companies are so sensitive to the interest rates. They need to borrow capital. So when the cost of money gets less, those those companies,
Yeah.
or I should say in this case, when the cost of money gets tighter, as it's been in the last couple of years, those companies are hurt the most, and they're also the ones that are going to benefit the most when that
Yeah.
monetary policy becomes a lot looser.
You can totally see this in the index price action too. So while
Yeah.
big tech has led the Nasdaq and the Dow and the S&P 500 to new highs, the Russell 2K is still well below its all-time highs. It has lagged the last couple of years because of what Chris was saying. Tight money conditions makes it harder for them to operate. But now we've got this. I wouldn't call it the actual all clear, but it's like a heads up. The all clear is almost
Right.
going to be here. So now investor money is starting to flow into these stocks.
Well, I know you both have a list of some specific stocks that you think could see some of the biggest benefits from the stock rotation happening right now. And we're going to get to those picks in just a minute. But first, here is some information on a tool that you can use to keep track of all of the market movement happening right now. Want to keep your finger on the pulse of the market? Text the word YouTube to 68285. That's 68285 and get free breaking news alerts from MarketBeat for the stocks that matter most to you. Don't miss out on crucial updates. Stay informed and stay ahead. So, Chris, what is one of the first stocks that comes to mind to you when you think of the benefits from the current rotation?
Well, I'm going to start with one that Thomas and I have been on the opposite side of the Coke Pepsi debate over the years, but this time I'm actually I'm throwing down with Thomas. I'm going with Pepsi here. I think this is one of the stocks that's going to be a clear winner when this sector rotation happens. The stock's down about 7% in the last 12 months, and it's really because the company's been issuing cautious guidance. The numbers have been coming in fine, but the company keeps issuing that guidance and the investors are kind of spooked by that. It's trading around 20 times forward earnings. It pays a great dividend. The analysts aren't jumping on board yet. Again, that's been largely been due to the guidance, but I think as soon as that guidance changes, it's going to be time to that you're going to want to be in Pepsi stock.
Right. I love Pepsi. It's a great stock. It is down near long-term lows.
Yep.
Technically speaking, it is setting up for a very nice secular grade trend following signal. It's getting ready to move up right now. It's moving up today, I think, from this critical support level. As far as the business goes, its diversified model is really what's got it set up for success because it's going to kill it with sodas, but also with snacks. As people become more affluent and there's more discretionary spending, they're going to start buying more snacks and they're going to stop buying cheap snacks and start buying the ones that they want to eat that taste good, the ones that PepsiCo makes, right? And even more so than that, PepsiCo's big growth strategy right now is leaning towards international markets. The emerging markets are killing it right now. They are outpacing the global growth, outpacing United States growth. You can see it in results from like WD-40 Company, McDonald's, um, PepsiCo was one, Kraft is one. They're doing real well in Latin America. Africa looks pretty strong. India's pretty strong. Southeast Asia's pretty strong. So as lower rates come down in America, it's going to impact economic activity around the world, and it'll help reinvigorate and invigorate those emerging markets, and that will definitely play into PepsiCo's results.
Well, sounds like PepsiCo is a great company to watch during this rotation. But Thomas, what other stock are you watching the most during this rotation right now?
Well, one of the ones that's high on my list is a small cap consumer discretionary Darden Restaurants. Now, this is the parent company of Olive Garden, Longhorn, Ruth's Chris, Cheddar's, several other names. It's got value, it's got a high yield, it's growing, it's got activist investors working with management trying to unlock value and increase margins. The balance sheet is improving. It's down a little bit now because of cautious guidance, but this interest rate shift should play into that guidance. It might not come out in the next quarter or so, but as that shift happens, discretionary spending should improve, and we should see that in their results. Solid labor markets support this stock because people have to have jobs to go out to eat. And then the analysts see 20% upside. Some of the recent revisions have lower price targets, but they're setting this up for an upgrade cycle. So once these numbers start to improve, the analysts will start raising their targets again and reinvigorate the bull case in this market. As it is, they're looking at 20% upside.
Chris, what do you feel about this 20% upside for Darden restaurants?
Oh, I think that might be conservative, actually. I think the whole reality is the markets are going to be forward thinking right now, and restaurant stocks have been one of the worst performing stocks in the first half of the year, and that's where I believe, especially the institutions, that's what they're looking at in the second half of the year. If there is a rate cut, and if we start seeing the consumer have a little bit of that pressure taken off the consumer, that's a lot of where the discretionary dollars are going to be flowing.
Well, I'm sure that there are plenty of more companies with the potential to see some big investments coming their way during this rotation. We've only covered a few so far. We want to talk about more. Thomas, what are a few other specific stocks you're watching during all of this?
All right, I'll start with a sector level view of housing and construction stocks. Home Depot and Lowe's are very well positioned for this move. They're not really growing now. They're kind of struggling with, flattish results. They're definitely impacted by higher rates and a stalled housing market. Lower rates will not only invigorate the new home market, but existing home market and the remodel market, which are their three main businesses. So, extending that into the small cap names, which are supposed to be doing the best right now, names like Geld Wen are particularly well set up because they're going to be selling product to builders, to homeowners, as well as through companies like Lowe's and Home Depot. So when HD and Lowe's get a boost, Geld Wen and all of the ancillary construction component stocks will also get a boost. Geld Wen specifically has got a return to growth in the forecast. The housing boom should lead to an upgrade cycle in the analyst forecast. The analyst activity has been pretty tepid this year, so there is absolutely opportunity present. And most importantly, though, this stock is profitable now. It's been outperforming and widening margins, so it's building leverage for the rebound. When revenue starts to grow, earnings are going to outpace that growth, and that really plays into shareholder value.
Now, Chris, how about you? Are there any more companies or sectors that are on your radar among all of this?
Yeah, I'm going to stick with the food and beverage category and go with Domino's Pizza. This is a company that, like McDonald's, has kind of figured out how to use technology and even AI to turn what would be a kind of a boring fast food company into a more robust technology company. The stock dipped a little bit after their last earnings report. Again, a lot of that had to do with guidance. They might not be opening as many stores as they were expecting, and that's not only domestically but internationally. But Domino's is figuring out how to use AI to improve delivery times. They're jumping in on the electric vehicle trend in terms of the last mile delivery with their drivers, and putting electric cars that their drivers can already use so that the drivers don't have to use their own vehicles. It's just a company that they're using technology in a smart way to improve their margins. This is a company to watch, especially since you're getting it on a little bit of a dip right now.
Thank you both for the great list of stocks to watch during this rotation. We're going to continue to follow all of the movements in this market rotation right here at Market Beat. So be sure to stay tuned for more. But for now, happy investing.